Brent Crude just collapsed 16% in 3 days. The entire war premium is gone, from $100 last week to $80 today. That's not a pullback, that's a liquidation. The level that matters right now? 82.19. Break that and we're racing to 80 flat. Brent Crude just did something that only happens a few times a year. In 3 sessions, this market has shed 16% of its value. That's not a correction, that's a full-blown liquidation event. And right now, there is one danger zone and one hidden opportunity. I'll show you both. Last week, oil was trading above $100 a barrel. Today, we are sitting at $82.73. The entire geopolitical risk premium that took months to build has been wiped out in 72 hours. But here's what most traders don't understand. This sell-off might not be over. And the next leg lower could be the fastest one yet. Stay to the end. I'm giving you 2 scalp plays and 1 swing trade you can execute today, plus the 1 headline that flips everything. Let me give you the verdict immediately. The session bias on Brent Crude is aggressively bearish trending. Not fading, not range-bound, trending lower with conviction. The daily trend is a strong sell. The 4-hour trend is a strong sell. The 1-hour trend is a strong sell. Every time frame you look at is aligned in the same direction. The ADX reading is sitting at 46, which tells us this trend has serious momentum behind it. When ADX climbs above 40, you're looking at a trend that doesn't reverse easily. Write this number down, 82.19. If we break below that level today, the entire structure resets and we are looking at a direct path toward $80 and or lower. The herd is positioned long. Retail traders have been buying this dip all the way down, convinced that $100 oil is coming back. That's exactly why this sell-off has room to run. When the crowd catches a falling knife, the market usually teaches them a lesson. Let me walk you through the chart from the weekly down to the hourly, because the story here is absolutely textbook. On the weekly time frame, Brent is now trading below the 200-period moving average at 82.99. That's significant. This average has been a critical dividing line between bull and bear markets for over a year. Breaking below it on a weekly closing basis would confirm that the long-term structure has flipped. Now look at the daily chart. The 50-period moving average sits at 86.40. We are almost $4 below that level. The 100-period moving average is at 86.28. We are below that too. The only moving average still above price is the 200-day at 82.99, and we are testing it right now. This is the last line of defense for the bulls. The MACD on the daily is showing momentum divergence. Price made a lower high, but the MACD histogram is still positive at 0.934. That's a hidden divergence that often precedes sharp reversals. But here's the catch. Momentum indicators can stay diverged for a long time in a strong trend. And this is a strong trend. On the 4-hour chart, the RSI is sitting at 47.4. Not oversold yet. That means there's still room for this sell-off to extend before we see any meaningful bounce. The CCI is at negative 38. Again, not extreme. The Williams %R is at negative 62. We are not at panic levels yet. We are at capitulation in progress levels. Here's what most traders miss. The ATR is 4.3. That means this market is moving over $4 a day on average. When volatility is this high, your stops need to be wider than usual, or you'll get stopped out by noise. Now let's talk key levels. The pivot point is 86.49. We are well below that, which confirms bearish control. Resistance 1 is 88.13. Resistance 2 is 89.15. Resistance 3 is 90.19. These levels are miles above current price. That tells you how far the bulls have to climb. Support 1 is 84.85. Support 2 is 83.83. Support 3 is 82.19. We are trading below the first 2 support levels already. That's bearish. The only support standing between current price and $80 is 82.19. Just this morning, Reuters confirmed that Brent Crude fell as much as 9.5% earlier in the session to 87.50. 5, the lowest since July 20th. And we've continued lower since then. The selling pressure is relentless. Now let me connect the news to the price action, because this is where the real story lives. The dominant narrative in the oil market right now is the massive unwinding of the war risk premium. 2 weeks ago, Brent was trading above $100 a barrel as the US and Iran exchanged strikes and the Strait of Hormuz was effectively closed. That strait normally carries about 20% of the world's oil. When it closed, the market panicked, then everything flipped. President Trump confirmed that the US and Iran are engaged in talks to try to end the conflict. The US ambassador to the UN said attacks on Iran had been halted to give talks some space. Iran's foreign ministry announced progress in negotiations with Oman on management of the Strait of Hormuz. The market interpreted this as a green light to liquidate every single barrel of war premium. But here's what traders are not pricing incorrectly. The Strait of Hormuz is not fully operational yet. Data on actual shipping confirms that traffic remains muted. On Monday, only 4 vessels crossed the strait. Tanker traffic has not normalized. The diplomatic talks could still collapse. They've collapsed before. Goldman Sachs analyst said in a note that reported talks between Iran and Oman to reopen the strait could pave the way to resume US-Iran talks. But they also cited Red Sea attacks over the past weekend by Yemen's Houthi rebels, who claim to target Saudi oil infrastructure, including the kingdom's Jazan oil refinery and the Yanbu oil port. Goldman still expects Brent to moderate to $80 by year-end if Hormuz fully reopens by Q4, but Red Sea disruptions and attacks on Saudi oil infrastructure may pose a new source of upside risk. Do you think Brent finds support at $80 this week? Comment yes or no. I'm tracking consensus.j.p. Morgan Global Research now forecasts Brent crude to average $86 per barrel in the third quarter of 2026, $80 in the fourth quarter, and $78 at year-end. That's a significant downgrade from earlier forecasts. The cross-asset linkages are critical here. A hawkish hold from the Federal Reserve today at 2 p.m. Eastern Time will strengthen the US dollar, creating automatic structural headwinds for dollar-denominated commodities like oil. If the dollar breaks higher, oil breaks lower. It's that simple. OPEC Plus is also a factor. The group approved a 188,000 barrel per day output hike for August, the 5th consecutive monthly increase. Russia's production is scheduled to increase by 62,000 barrels per day, Iraq's by 26,000. This is supply coming back online at exactly the wrong time for the bulls. Most people skip this section. That's exactly where the money is made. Keep watching. I'm giving you 2 scalping strategies and 1 swing strategy. Every setup comes with exact entry prices, stop losses, and profit targets. Write these down or screenshot the screen. You'll need them. Strategy 1, the opening scalp, scalping, high probability. The first scalping opportunity focuses on a 5-minute structural trigger right at the 82.19 support level. The trigger condition is simple. Price taps 82.19 and prints a bullish engulfing candle on the 5-minute chart. That's your entry signal. Your entry is at 82.40. The tight stop loss goes at 82.05, just 15 pips below the low of the engulfing candle. Take profit 1 is at 82.90. That's a 1 to 1.5 risk-reward ratio. Take profit 2 is at 83.40 if momentum extends. What instantly voids this scalp? If the 5-minute candle closes below 82.19, the setup is invalid. That level becomes resistance and we are heading lower. The opening SCLP entry, 82.40, 5M bullish engulfing after tap of 82.19, stop loss, 82.05 take profit 1, 82.90 take profit 2, 83 to 40 risk reward, 1 minute and 1.5 seconds, TP1, invalidation. Void if 5M candle closes below 82.19. Strategy 2, the liquidity grab, scalping, counter noise. The second scalping strategy is a counter trend play that targets the stop hunt zone just above the recent swing high. The 15-minute chart shows a clear stop cluster above 84.85. That's the first support level that flipped to resistance. Shorts are piling in there, and their stops are stacked just above. Here's the play. Wait for a fake breakout above 84.85. Price spikes up, triggers the stops, then snaps back below. That snapback candle is your entry. Entry is at 84.40 after the confirmation candle closes below 84.85. Stop loss goes at 84.95, just beyond the wick of the fake breakout. Target is at 83.83. That's the nearest intraday liquidity pull below warning. This requires fast execution. The fake breakout can last only 1 or 2 candles. If you miss the entry, don't chase it. The liquidity GROB entry, 84.40, 15M snapback below 84.85 after fake breakout, stop loss, 84.95 take profit 1, 83.83 risk reward, 1:1.3 invalidation, void if 15M closes above 84.85. Are you scalping or swinging this week? Comment scalp or swing. I want to see where this community sits. Strategy 3, the session swing, trend alignment, now for the swing trade. This one captures the multi-session move based on the daily and 4-hour bearish bias. The trigger condition is a 4-hour close below 82.19. That's the critical invalidation level I mentioned earlier. When price breaks and closes below that level on the 4-hour chart, the structure flips entirely. Entry is at 82.05 on the close of that 4-hour candle. Stop loss goes at 83.05, $1 above entry, placed outside the daily structure. Target 1 is at 81.05. Target 2 is the psychological level at $80 even. Trailing stop rule. Once price reaches halfway to target 1, around 81.55, move your stop to break even. Let the trade run with no risk. Explicit invalidation. If the daily candle closes back above 83.83, the medium-term bearish outlook is void. The session SWNG entry, 82.05, for H close below 82.19, stop loss, 83.05 take profit 1, 81.05 take profit 2, 80.00 risk reward, 1 minute and 1 second, TP1, 1 minute and 2 seconds, TP2, invalidation, void if daily close above 83.83. Never risk more than 1 to 2% per trade. Scalps demand even tighter risk. This market is moving $4 a day on average, so position size accordingly. No positions through high-impact news. The EIA inventory report drops at 9:30 a.m. Eastern Time, and the FOMC decision hits at 2 p.m. Eastern Time. Be flat or hedge before both. Stops are non-negotiable. This is how you survive to trade the next big move. Let me summarize the single most critical level for the next session. 82.19 is the line in the sand. Below that, we are targeting $80 and potentially lower. Above that, we could see a short squeeze back toward 84.85. But the path of least resistance is down until the Fed or the EIA changes the narrative. Tease tomorrow's focus. The Fed decision at 2 p.m. Eastern Time is the wild card. If Powell sounds dovish, the dollar drops, oil rallies, and everything changes. If he's hawkish, oil accelerates lower. If this level breaks, the whole monthly trend flips. I'll have the updated blueprint 24 hours from now if you want the full breakdown on Aussie dollar. Japanese yen, Nike 225. Those videos are live now on our Alpha Market Meridian channel. Gold, Nasdaq, and Bitcoin are published on the Market Meridian channel. Please click the link at the top of this channel's homepage to access the complete institutional suite. Tap the end screen to jump to the gold melt-up analysis and then loop back to today's Nasdaq gamma flip later. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that matter.